Hey, welcome everybody to another show of Real Estate IQ, the show that brings you deep insight into the South Florida real estate market. Today, I am very excited for this very special show, our first show in front of a live audience. I am joined today by two great friends and experts in their field, Belkis Rodriguez, co-founder of Universal Mortgage, chief underwriter, and Diego Londoño, branch manager for Caliber Home Loans. Guys, thank you so much for being here today.
Thank you, Ricardo.
Thank you very much.
Today we have a very important topic, which is about financing and how we can use financing to leverage our investments. So I'm going to start with you, Belkis. Tell me a little bit about what are some of the key aspects and things to consider for you as a lender when evaluating a loan to a domestic or a foreign investor.
Well, I think we are all somewhat familiar, you guys are all somewhat familiar with what the requirements are for domestic financing. Credit, capacity, ability to repay, income, etc. But there is a significant difference between that of a domestic borrower and that of a foreign national borrower. Foreign national borrower, for the most part, does not have credit established here in the United States. So we have to lean on other variables that show their strengths in their country, one of which is their income, the capacity that they have to pay, and the amount of asset or wealth that they have in order to be able to successfully invest here in the United States. So we look at several factors, but those being probably the most important ones.
So foreign investors usually don't have the ability to show, for example, what a domestic person would have in terms of like a credit bureau.
Right.
What are some of the hurdles that you need to get over in terms of evaluating that creditworthiness and the verification of what they're providing?
Absolutely. So since we do understand, we are in the hub of the area of the country that handles or does receive the majority of that type of business. South Florida is the hub for foreign national investments. So we understand that very well, and we also understand that in those other countries, those foreign investors that come to our country to invest here, they don't necessarily file their tax returns like we would here in the States. So instead of asking for tax returns, what we would ask for is a very strong letter from their accountant, their CPA, to show their strength as far as their income, the type of business that they have, or if they're employed by a firm, by a company, then we would want to see a very strong letter of employment. One of the significant differences between a domestic investor and a foreign investor is that we're obviously going to ask them to put more skin in the game, more of a down payment, and in addition to that, because we want to prove that they have the financial wealth and the financial health to be able to continue to successfully invest here in the States, is that we're also going to be looking for reserves. So not only do we have to prove that they have enough monies to put their 35% down payment and cover their closing costs, but we typically ask for 12 months of their principal, interest, taxes, and insurance payment. We have to verify that. Now, mind you that those monies do not need to be here in the States. We can verify that from a foreign bank, an account from their country, or any other country for that matter.
Great, thank you. Diego, what are some of the main programs that domestic and foreign investors can access to leverage those investments? Give me a sense of what are some of the current rates in the market, some of the down payment requirements, and give me a little bit of insight as to the difference, for example, between doing it for a condo versus a single family home that is not in a condo.
Okay, I'll start with the last question first.
Okay.
So for a condo, when we're talking about a foreign national, the minimum down payment is going to be 35%, as opposed to a single family residence where the minimum down payment you can bring is 30%. So that there is a variance between a condo and a single family residence for a foreigner. As far as a domestic borrower, the minimum down payment that you can do for an investment is going to be 15%, and for the investment side for domesticers, we have a lot more leverage in the programs that we have, such as we can do rehab loans for investors if you're doing domestic loan. So we can project the future value of the property, and we can build that in to the repairs. That's a very aggressive program where we don't have that with a foreigner. To her point, a foreigner, really we want to see skin in the game. We want you to come with a big down payment, and that's basically about a 30%. Rates are going to be anywhere between 4.5 to 5.5, all depending on the loan to value, how much money you're bringing to the closing table, and you can always have the option to buy down your interest rate, which foreigners typically like to buy down their interest rates. You usually see that on a foreign loan. Domestic people typically do not like to buy the rate down. They'd rather take the higher rate.
Essentially paying something up front to get a lower long-term lock rate.
Correct. So typically what you're looking at is basically about between 1 to 2% of the loan amount, and then you're able to kind of buy down your interest rate.
Is there any differences between nationalities? Do some nationalities have different requirements than others?
No, not really. There's some nationalities that we won't do at all, but for the most part, the field is same across the board for everybody.
Now, Belkis, explain to me a little bit about the difference in terms of taking title for an investor. They do it as an individual versus investing through one of the legal entities that we talked about earlier, an LLC, maybe even a trust. Are there differences in terms of the requirements that you need to underwrite that loan?
Yeah, actually there are. A foreign borrower is actually, I would say to a certain degree, asked to actually incorporate or create an LLC for the purpose of purchasing the property. It's actually looked as a positive attribute to the loan itself, to the loan quality. However, if the LLC or that corporation is formed prior to purchasing this property for another reason outside of just this property's purchase, we will want to see the health of that LLC. We want to see how long that LLC has been established, what other assets or liabilities that LLC has. So yes, I would say that there are, you would add an additional layer of documentation and verification if you do incorporate an LLC into the purchase of a foreign purchase.
So this question I'll ask to both of you, and I'll start with you, Diego. In a real estate transaction, there are many parties that are involved, right? You have realtors, brokers, lenders, attorneys and title companies, etc., inspection companies, appraisers, etc. It can get very complicated. Why don't you share with me some best practices that you've seen over your career that could be some advice for realtors? So some of the best practices to create a smooth transaction between the realtor, the lender, and the title company.
Number one, without a doubt, is communication. There has to be communication from the start, and it's never too early to start asking questions, because as the panel before me, as they were answering their questions, there's a lot of stuff that I could have interjected, because a lot of what they do influences what I can lend. So without communication from the beginning, we can cause a lot of heartache throughout the process. So without a doubt, for me, communication, talking to each other, how are you going to structure your LLC, what are you expecting out of the appraisal? Are you doing this as a primary? Is this going to be your true second home? If you're going to do it as an investment, how are you going to set up to verify, the rent that's coming in for future loans? Because it's very important that, remember, what we do today is going to impact you 2 years down the road. Your investor gets a portfolio of 5 or 10 properties, right? You guys Avanti does a fantastic job of managing that, right? What I do once they have 5 or 10 properties, I grab that. Now I give them a commercial loan. I give them a line of credit so they can go out and buy more properties. And I need all that documentation to be very, very accurate. And with the management system that they have, it makes my life very simple to get all the documentation. So for me, I think communication, it's never too early. Everybody says, oh, well, I'm going to call, we'll talk in 2 months because they're not ready yet. I need to talk to them today, because they need to make sure that they're doing all the right steps as we instruct them to, so when the 2 months come up, we're ready to lend financing.
So a great point in terms of the client who doesn't always know what they don't know is saying, whenever I'm ready, I'll let you know. And I think to this point, the earlier that we can have that communication begin, the better we will position ourselves for a successful loan. What about you? What are some of the best practices that you can recommend to our realtors and to our investor audience that's watching us?
Well, in addition to what's already been said, which is really when your borrower tells you that he's not ready, that's when he is ready. He or she needs to be informed, needs to be guided from very early on into the process, so that we avoid delays or issues, even greater, such as your deal falling apart. What we do at Universal Mortgage that does set us apart a little bit is that we create a distribution list from the very beginning that includes all parties that are involved in the transaction. And that distribution list is whenever there's any type of communication, be it little or large. We've overcome a small issue with the title. We just got the appraisal, and everyone is involved, everyone is notified, so that there are no issues with the listing agent not knowing what occurred in the transaction, because we included them in the distribution list. So it's important that communication be very, very clear and transparent, mainly from us, because we're really the ones that are behind the big picture when it comes to financing, and a lot of the responsibility falls on us as a lender. So we don't take that lightly. We make sure that all parties are completely involved and that everything is transparent.
What are some ways that you, I'll ask both of you, what are some of the ways that you can help people who currently have multiple investments and maybe they've built a lot of equity, or maybe they paid cash after the last crash and they got great asset values and they just have a lot of equity that's sitting there? What could we offer those investors that are watching for them to be able to take some of that equity out and maybe make new investments?
Absolutely. I mean, the obvious answer to that question would be to refinance those current investments and then take the equity or the equitable portion that we're able to lend on so that they can reinvest. But that's just the broad stroke of the answer, no? There's many different ways that we could do that. We could do it case by case. We could do a bridge loan. We can do a commercial loan where we incorporate several properties into one loan. So there's many ways of doing it, but when your investor tells you, I'm tapped out, I don't have any funds, your next question should be, tell me about your properties. Tell me about the assets that you have that you may think don't have any liquidity, but they actually do.
What about you, Diego? How could you help? And talk to me a little bit about income producing properties and how we can use that income from the other properties to really make it a part of the underwriting process and help people leverage what they already have.
Okay, so I think first is identifying what is the goal of the person who wants to invest. Are they looking for a short-term investment, or are they looking for a long-term investment? I'm not going to give somebody a mortgage to incur closing costs if there are going to be a short-term investment, as in they're going to buy a property, they want to fix it up, they want to flip it, they're going to sell it, and they're going to get their funds back, right? In that scenario, I would give somebody a line of credit, right, where they can take out the funds, minimal closing costs, variable rate, moves with the market, okay, but they can go ahead, do the rehab, 6 months, 8 months basically, and stick the money back in the bank, and they only paid interest for those 8 months, okay? If it's a long-term investment, then yeah, I'm gonna go into a traditional refinance where we can go ahead and give them a long-term fixed rate. He wants to buy another investment property, he wants to hold it for 5, 10, 15 years, he wants rental income. At that point, we're gonna give him a traditional mortgage. What's the second question you asked?
So if you have income producing properties
Income producing properties, and it's very, very, very important that we document the income producing properties. If you buy, let's say, a 3 or 4 unit, right, you need to have a minimum of a 12-month lease established. You need to have a separate bank account showing the money coming in. You need to manage it. The banks are going to look very closely the way you're managing your cash flow, the way it's coming. So I would tell you, documenting everything in an orderly fashion, making sure that you're meeting all the dates that you have to with your leases. Don't do short-term leases that they're not going to be good for you. We won't consider that effective rental income.
So just that brings me to a question that I thought about now. This trend of Airbnb properties, right, and these short-term leases, are you able to finance properties with the intent of using them for short-term rentals and Airbnb properties?
That's a great question, because we actually closed a loan last week with an Airbnb investment property. The key to being able to solidify that transaction is that everything has to be documented. We have to have tax returns, and this is more on a domestic side, no? But we have to have tax returns that reflect that Airbnb income coming in. So a Schedule E that shows the rental income, whether it's Airbnb or any other one of these entities that are out there. The point is that if you have an investment property, or your borrower has an investment property, and they're collecting rent, that you instruct them accordingly that they must document it and file taxes accordingly so that we can give them the proper credit for that income.
Well, this has been a super illuminating panel and obviously wide-ranging set of options. I want to thank you guys for joining me here today. To our audience, thank you. We thrive on all of your questions and ideas, so please keep them coming. If you guys want to learn more about how you can use leverage and financing to invest here in the South Florida real estate market, reach out to us on our social media. Till next time, thank you for joining us, and we'll see you soon.